Welcome to TheoTrade. This is Don Kaufman. It's April 23rd, 2025. There's just about 50 minutes to go to the cash close here on this Wednesday afternoon. The S&P is explosive once again to the upside. Now, kind of ironic here. The S&Ps are up some 90 points, and I'm like, oh, it's explosive to the upside, but well, they're way off the cash open. And we literally traded 5,500 this morning. The S&Ps have actually, this feels like sell side activity. The S&Ps are only up 86. And I got to tell you, okay, kind of the theme this evening. Look, volatility, it's down, but it's most definitely, okay, not out. I'm actually going to explain that and a whole lot more here on this TheoTrade evening video. Let's get right to work, because one of the areas that really just begs to be discussed. This is something that's not like incredibly rare, okay, but it really begs to be discussed because, well, let's break it down. One of the first things, the lines that you're looking at on the screen, okay. This is where the week started. This is what we term the upper edge of the expected move, and this is the lower edge of the expected move. The expected move this week is plus or minus, wait for it, $168. So why am I bringing that up? Because on Monday, we traded, well, $168 plus lower. By Tuesday, we had rallied back up to massively unchanged. And this morning, we actually hit the upper edge of the expected move. I mean, you got to realize it's $168 to the downside, $168 to the upside, and all kinds of chaos in between. But when people look at moves like this, and one of the things that I really want to have resonate with you on this evening's video is that you see moves in the marketplace. People are like, this is unprecedented. Unprecedented? What are you talking about? There's a line that we drew on the screen. Okay, that line represents the expected move. And that expected move, it's not just a random number. It's like an average, if you will, of the option premium inside of the SPX as of, okay, typically it's on a Friday, but markets were closed last Friday for Good Friday. So this line was actually drawn last Thursday. And in, what people this morning, it's an unprecedented move to exactly the number that we had on the screen, which is roughly, okay, 54.50. And it's 54.50 inside of the SPX. And then we basically broke lower off of it. Okay. So where are we right now? And I love to give people what I term orientation. Like you gotta get a feel for where we are kind of on the week, because in most weeks, what we do is literally hit a lower edge of an expected move, kind of reverberate off of it. But we hit the lower edge, then we hit the upper edge, and then we pulled back. And it is rare to see both upper and lower kind of get hit, but it's really, really unusual when you have a $168 expected move. That is the unusual portion of it. So if there's anything unprecedented about this, it's just simply the magnitude of the move. But, well, we've seen a lot of this. Okay. The first thing that I really also kind of want to hammer home about the rally. Let's not talk about just movement and $168 expected move. The rally that we've seen, okay, from kicking off really yesterday into today, it has all of the hallmarks, if you will, of that kind of quintessential rip your face off volatility type rally. That is, and again, this is an opinion, that's not a good thing. And when I say it has all the hallmarks, what are some of the hallmarks, okay, of that almost like what we would term a bear market rally? One of them was correlation. You realize that yesterday, at one point yesterday, we actually had in the S&P 100, we had 99 products trading to the upside, okay? So it was like full-blown, full court press to the upside. It is what it is, okay? And it, only in extreme moves, like, look, it didn't matter who you were or what you were yesterday. Everything moved in accordance with the S&Ps. But as I was saying a moment ago, like that volatility, it's down, but it's definitely not out. One of the other things that really caught my attention this morning, okay, is that we had this, incredible move actually overnight. You were up 200 points this morning in the S&Ps. That one is kind of an unprecedented. I mean, 200 points to the upside. But one of the things that was really shocking is that volatility, okay, in the 0 DTE was actually elevated this morning considerably, meaning that instead of options decaying kind of like overnight, they shot up in premium, okay, by about 60% premium over where they were the previous day. It was crazy. Just absolutely crazy. I don't think a lot of people caught that. So this is where a lot of people, they look over at the VIX and they're like, the VIX is down, man. We're all going to be okay. But you're not going to be okay because the VIX that was down considerably more, it's only down 5%, okay, with an absolutely massive move back to the upside. So yeah, the volatility came down a little bit, but not enough. And it's still like, this is basically firing warning shots across the bow. The volatility futures tell a little bit more of a story in here. The volatility futures have come off nominally. Okay, and what we term backwardation, okay, is still completely in play. It's not as big as it was, okay, and what we're talking about with backwardation, that is, okay, we're still in the throes of considerable risk. But that, and how do I actually distinguish that, is look at the May volatility futures, they're 2580, versus all the way 147 days out, it drops down closer to 24. So we're in backwardation. What it basically means is crap's hitting the fan now, and some of the risks should abate in the future. And you better recognize that when the volatility says that crap is still hitting the fan, okay, stop looking at the VIX and start paying attention to the volatility, which it implies that, you know, once again, you look, you're an earnings announcement or a tweet away, okay, from this marketplace turning into Mr. Toad's wild ride again. Speaking of Mr. Toad's wild ride, you need only look at the financials. And the financials traded 48.73, okay? They're over $1 lower than they were this morning. So for a rip your face off rally, that definitely leaves, okay, quite a bit on the table. The energy sector, which was ripping this morning, that thing's actually down on the day. There's, you know, dissension in the ranks over here. So I also want to take it a bit of a step further here. The VVIX did dump down, but we're still actually trading. This is the volatility of the VIX. This is still trading 110, which is a really serious level. Okay, for all intents and purposes, as I said, you're still in the throes of risk. And there's another very interesting number on the screen right now, and that is, okay, this is actually what we term skew. And the skew did, in fact, drop dramatically. And what the skew is, it's way out of the money puts, okay, versus out of the money calls. And what you see is the out of the money puts are not necessarily trading for the dramatic premium. So if anything, that skew actually says, oh no, some of the risk really did abate. But I did a little homework on this one. I was looking at skew and I'm like, yeah, so skew is actually 30-day volatility skew. But yeah, I did a little homework in here and I went into the spiders, okay? And I went into some of the back month options. And one of the things that I found that's actually pretty shocking, and you guys are welcome to look at this, okay, kind of on your own accord, go like 115 days out in the spiders. And again, you know, people look at stuff on the surface, you know, hey, I looked at the volatility, it was down. Okay, volatility's down. Yeah, well, check this out. So I'm 114 days out in the spiders, okay, which is the August 15th expiration. I'm going to close up this left side bar so give you guys a really good look. And I'm looking at a 6 delta. I always like to key into a 6 delta. And this takes us all the way down. I'm just going to, there's a lot of 6 deltas in here, but I just want to highlight this. Okay. You realize that you're looking at an option 114 days out. Okay. Even the 400 strikes, these things are still trading for $3 on, get this, 37s and 38 vols. Okay. The skew in the back month options. Okay. Still absolutely there. Put on your big boy pants. You start going down to like 3 delta, you're all the way up to like a 45 vol. And even though that may not necessarily be prevalent, okay, in some of the, okay, shorter duration stuff, it is absolutely prevalent, okay, in back month options, okay, are still jacked up in terms of premiums out there. So the bottom line with this is, you keep your head in the game. And I know people are concerned about earnings. Look, I'm going to trade tons of earnings. In fact, tonight, I am actually trading tons of earnings. I got positions on IBM, okay, and Love, LR, CX and LVS. I got positions in all of them for earnings tonight, but that is not okay what I'm concerned about. What I'm concerned about is that the S&Ps, okay, even if they do sustain a little bit more upside, we are very likely still in kind of a fit of rage in this marketplace. And just because we had a 2-day rally, if anything, that rally, okay, again, it just checks the box for the hallmark of volatility, okay? And it just further goes to like, I almost don't like to see the rally as intense as it was, because the intensity of the rally often defines, okay, what you're about to look like in the next couple of days. All right, that being said, let's pull away from that for a second, because people get all kinds of freaked out. Okay, if you continue to have any upside in the next day or two, right, into Thursday, Friday, maybe even one of the earnings announcements does spark a little bit more of a rally, I think it's a great shortable opportunity at that point in time. Because look, all of this is for nothing if you can't translate it into trade specifics. Okay. And yeah, we're going to go through the likes of like Meta, and that's, and Google, like, later this week. And I mean, Google's a pretty big one, right? Tomorrow. And okay, obviously we have to deal with Amazon. That's next week. But there's some huge earnings ultimately coming out. And stuff like Google could actually spark markets to have a little bit more of upside, which I think at that point, okay, you have this great context then behind you. Like, all right, the rally has happened. Okay, at that point, we might be able to step in and have a nice shortable opportunity. That's actually what I'm waiting for, especially with a couple of in-out spreads. And look, if you're scared of some of the earnings over here, not a problem. ETF fill is right down below over here. So look for the opportunity if we do keep the bid under this marketplace in the next day. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.